Hi, I'm Rachel from Strategic Solutions Chartered Financial Planners. We are a firm of independent chartered financial planners helping clients make the most of their money, from pensions and investments to mortgages, protection and estate planning. Today we're going to talk about general investment accounts, or GIAs, plus we'll be exploring capital gains tax, often called CGT. We'll cover what they are, how they work, and what to keep in mind if you're using a GIA as part of your financial plan. What is a GIA? A general investment account is a flexible way to hold investments. Unlike an ISA or pension, it doesn't have an annual limit on how much you can put in. You can invest as much as you like in a wide range of funds, shares, bonds, or other assets. The trade-off is that a GIA doesn't give you the same tax advantages as ISAs or pensions. That means your investments could be subject to income tax or dividend tax on certain earnings, and capital gains tax when you sell them at a profit. When might you use a GIA? GIAs are often used when you've already used up your ISA and pension allowances but still want to invest more. They are also handy if you want to access your money without the restrictions that come with pensions. What is capital gains tax? When investing in a GIA, you must consider that any growth could potentially be subject to capital gains tax, or CGT. CGT is a tax on the profit you make when you sell or dispose of an asset that has gone up in value. It's not the total sale amount that's taxed, just the gain that you've made. For example, if you bought shares for £10,000 and sold them for £15,000, your gain would be £5,000. Allowances and rates. Everyone has an annual capital gains allowance. In the current tax year, 2025-2026, that's £3,000. If your total gains in a tax year are below this, you won't pay CGT. If you go over, the rate you pay depends on your income tax band and what type of asset you're selling. Residential property gains that aren't your main home are taxed at higher rates. Managing CGT. There are ways to manage and potentially reduce CGT. For example, making use of your annual allowance each year, spreading sales over different tax years, using losses to offset gains, holding investments inside tax-efficient wrappers like ISAs or pensions. Risks and considerations. While a GIA is very flexible, the lack of tax advantages means it's important to keep an eye on your CGT exposure and income tax position. And of course, investments can go down as well as up, so there's always some level of risk. At Strategic Solutions, we help clients decide when and how to use a GIA alongside other tax-efficient options. We also look at how to manage potential CGT in the most efficient way possible, so more of your money works for you. If you'd like to understand how a GIA might fit into your plans, or how to make the most of your allowances, get in touch with us. We'll be happy to help.